Does your merchandise business sell too many products to be able to accurately track quantities on hand? Well, then you need to use the periodic inventory method of recording transactions. If you have any questions about this topic, you can leave them in the comments section below and I'll do my best to help you. And of course, if you feel the video helped you, I hope you will click like and don't forget to subscribe to get updates on new videos that come out all the time. The periodic inventory method is appropriate if you cannot keep records of specific quantities on hand after each transaction. If that's the case, then you must use the periodic inventory method of recording your transactions. You see, with this method, you can only calculate cost of goods sold when you are ready to report your profit and loss and the rest of your financial statements. You don't calculate it in the accounts like we learned with the Perpetual method. You instead calculate the cost of goods sold right on the income statement. Now, what am I talking about? Well, the profit and loss of a merchandise company has sections and subsections. The numbers are in a relationship to each other, and cost of goods sold still means the same thing, but you can only find it at the end of the month or the end of the accounting cycle when you're ready to report your numbers. So, what did we already learn about the profit and loss of a merchandise company? Well, we know that we first calculate how much money came in from the customers for the merchandise we gave them. And common sense says we then subtract what we paid for the merchandise that we gave the customer. And the amount that we paid for the merchandise we gave the customer is the cost of the goods that were sold. And if we subtract them out, then we get our real profit from buying and selling the merchandise. Now, most of you remember this from your elementary school days. But when you find your gross profit from the merchandise, you're not really finished. You still have to subtract out operating expenses and any other service you needed to pay for in order to be able to buy and sell to get your real final result, which is the net income. And hopefully you've seen this before in your accounting class or in your travels, and hopefully this structure makes sense to you and should be very simple. However, you should know that when you use the periodic method of inventory, cost of goods sold is comprised of 4 separate elements. You see, you can't have a T account for the cost of goods sold if you have too many products to keep track of. So you do a series of logical steps to find and calculate the cost of goods sold. First, you start with beginning inventory, which is a T account in the general ledger that doesn't change as you purchase merchandise if you are using the periodic method. Instead, when you purchase merchandise, all of your purchases gets recorded in a T account called purchases. And then, of course, logic suggests if you add what you had in the beginning inventory plus your purchases, you would then get a number that represents the goods that were available for sale. And the last logical step to back into finding what the cost of goods sold is to subtract out your ending inventory, and then once you get that result, then you have the cost of goods sold to put into your income statement, subtract from your sales income to find your gross profit. And these are the 4 elements and the logical steps that you would do at the end of the month and show on the income statement in order to show that you have an accurate cost of goods sold and therefore an accurate gross profit and so on. But why is it that the cost of goods sold steps seem a little challenging? It's only because you're using the words in accounting instead of using common sense words. Think about what cost of goods sold is. It's what we paid for what went out. It's what we paid for what we gave the customer. So all we have to do is use different words, and it will be clear and common sense exactly what cost of goods sold is. Instead of using the words beginning inventory, let's just say we had some, because whatever your beginning balance of inventory is, represents what you had at the beginning. You had some. But then during the month when you record your purchases, you bought more. So instead of calling it purchases, call it how much more you bought. And logic dictates if you add what you had at the beginning plus what you bought, then you get a number that represents what you could have sold. So goods available for sale is the total that you had the ability to sell. We then subtract what we did not sell. And logic dictates if you subtract from what you could have sold the amount you did not sell, then the number that remains is what you did sell. So logically speaking, goods available for sale, which is what you could have sold, minus ending inventory, which is what you did not sell, equals what you did sell. And what you paid for what you sold is the cost of goods sold. So here's a practical example from an Amazon online store, keeping in mind that any company with too many different types of products and large volumes cannot keep track of the cost of goods sold for each sale. And just like a supermarket, they must count the inventory after each period that they want to report their numbers and use the periodic system. So here's the practical example. You cannot know your profit unless you know how many items were sold during the month and how much money of item costs were sold during the month. In other words, how much you paid specifically for the products that you gave the customers. Most Amazon sellers do not keep count of the quantity of items after each sale or after each purchase. So how do you know how many items and how much money of inventory was sold during the month? The solution is to use old school elementary steps to basically back into the amount of cost of goods sold during the month. So what does that mean? Well, let's think of it from an elementary school's point of view. Let's imagine at the beginning of the month you had some inventory. For example, you had 10 items. Then let's imagine during the month you bought more, and you kept track of how many you bought during the month, and that was 20 items. Now you don't know exactly how many you sold because you did not keep quantities of that which were sold, but what you can do is physically count the ones that remain and are with you at the end of the month. And if you count the amount at the end of the month in this example, and you have 5 items left over, how would you find out how many actually were sold and went out? Well, in order to know that, you would have to be able to add the first 2 numbers together. In other words, you would have to find out how many you were able to sell, and then of course you would subtract out the amount that you did not sell, which is the amount left over. So if we were able to sell 30 and we did not sell 5, then how many did we actually sell? And of course the answer is 25. Logically, if we had some, for example, in this example we had 15 at the beginning of the month, then during the month we bought 45 more. Well, we don't know how many were sold, but we know we can physically count the ones that are left over at the end of the month. And in this example, there were 25 left over. So remember, in order to find out how many you did sell, the first step is finding out how many you were able to sell. And in this example, you were able to sell 60 and had 25 left over. So in this example, how many did you sell? Well, you sold 35 because 60 that you were able to sell minus 25 that you did not sell because 25 was left over logically equals the 35 that you did sell. And now we will do the same thing we just did, but we will do it with money amounts instead of counted quantities. For example, let's imagine at the beginning of the month we knew we had $250 worth of merchandise inventory. That means we paid $250 for the items that were sitting here at the beginning of the month. Then during the month we kept track of how much we paid to buy more inventory. And therefore, we know the money amount that we were able to sell. We could also check the amount left over in ending inventory and figure out what we paid for that, so we know the money amount of what remains. And logically, we could figure out the money amount of the goods that were sold. And we know in this example it was 300 because $800 worth of inventory that we were able to sell minus $500 worth of inventory that we did not sell equals $300 worth of inventory that we did sell. And since we paid the cost for that $300 that we did sell, the $300 in this example is the cost of goods sold. And now we will do the same thing we've been doing, but using the proper accounting words. For example, instead of saying we had some, we're going to say beginning inventory was $250 worth of merchandise. And instead of saying we bought more, we'll call the amount that we bought more the very important word purchases. So these are the words that we would use when doing accounting and calculating our cost of goods sold. Now, the word able is in the phrase able to sell. So instead of saying the amount we were able to sell, the official word for this number is goods available for sale. And of course, instead of saying the amount left over, we call the amount left over ending inventory. So what's the proper word for the result? Well, the result is what you paid for the goods that you sold and went out. So if in this example $300 worth of merchandise went out, then that's what we call the cost of goods sold. Because $300 is what we paid for what went out, because in this example $800 worth of merchandise is what we were able to sell. That was the goods available for sale. 500 is what we did not sell. That was the ending inventory. So logically, we sold $300 worth of merchandise, and 300 is the cost of goods sold. Now let's do another example with the proper words. Beginning inventory was 400. Then during the month we purchased $350 more worth of inventory. And when we physically count the inventory at the end, we know we have $150 worth of inventory still sitting here. So of course the next step is to find out how much money worth of inventory we were able to sell, and that's the goods available for sale. So beginning inventory plus purchases equals goods available for sale, and goods available for sale minus ending inventory equals the cost of goods sold. And in this example, it is $600 because $750 were the goods available for sale, $150 was the ending inventory, therefore the cost of goods sold in this example was $600. Now, we need to know the cost of goods sold so that we can subtract it from the money that came in sales income to calculate the gross profit. Because common sense dictates the money that came in from sales minus the cost of goods sold, which is what we paid, equals the profit on the sales of the merchandise. So how was this done in the old days in the chart of accounts? Well, the sales were recorded this way. We had a separate account in the chart of accounts just to record all the money that came in from sales. And only the money amounts that the customers paid us got recorded in the sales income account, because that was recorded at the same time in the cash in bank account that we used in our general ledger to keep track of how much money we had in the bank. So we knew if it came in and it was a plus to the bank account, that it was also sales income. And each individual sale was recorded on the credit side of the sales account to keep track of the income, and the debit side of the cash and bank account to keep track of how much money was in the bank or came into the bank account. Then, of course, at the end of the month, we would total the money that came in from the sale, and that amount would be the sales income that we would subtract out the cost of goods sold to find the profit. So then you may ask, how were purchases recorded? Well, we had a separate account to record the money amount each time we purchased inventory, and of course, that was matched to the deduction of the bank account every time we paid for the purchase. And in the purchases account, we only put the purchase cost. We only put what we paid for the merchandise that we purchased. And every time we did that, we put the money amount on the debit side of purchases to keep track of everything we paid, and the credit side of the cash and bank to keep track of each reduction to the bank account. And after each purchase was recorded in the purchases account during the month, at the end of the month we would get the total purchases, and the total purchases would help us find the cost of goods sold to be able to subtract from the sales income to be able to determine our profit. But we know that what we paid for the purchases is not exactly equal to what we pay to what the cost of goods sold is. So how did we actually find the cost of goods sold? Well, we had our purchases account, and we had another account to keep track of the inventory, which is an asset, and that account kept track of what's physically here at the end of one month and the beginning of another. And then, of course, we had a separate T account just to show us the amount of cost of goods sold. And what would we do? Well, we would start with the beginning inventory. That means that if we looked at the inventory asset account in our chart of accounts, at any given moment, it would only show the amount of inventory we had at the beginning of the month. Now let's just remind ourselves what the calculation was. Beginning inventory plus purchases equals goods available for sale. Goods available for sale minus ending inventory equals cost of goods sold. So, the first thing we would do is remove the beginning balance from inventory asset and move it to cost of goods sold. We would do that by making a credit to the inventory asset to wipe it out, because that's no longer the inventory amount. That was the amount at the beginning. So since the number at the end of the month is not the same, we make a credit to wipe it out, and the balancing debit goes into the account cost of goods sold. Now the inventory asset is 0 after step 1. Now what would be step 2? Move the purchases to cost of goods sold. Purchases normally had a debit balance, so we made a credit to wipe it out and make purchases 0 so that we could account for only the purchases in each individual month, and purchases will become 0 as a fresh balance to record the purchases in the next month. And the balancing debit, of course, goes to cost of goods sold. Now, cost of goods sold now has this final third step. The ending inventory will go as a decrease to cost of goods sold. And we know the amount that we physically count at the end, which is the amount left over, gets subtracted in our little calculation. So that's why it goes on the credit side of cost of goods sold, because it gets subtracted. And of course the balancing debit goes into the asset account inventory, so that now is the ending inventory of this month, and now going into the next month, the inventory account reflects what's the beginning inventory in the new month. And now our cost of goods sold account in the chart of accounts has every part of the calculation. On the left, it has the beginning inventory and the purchases. So the total on the left is the goods available for sale. And we know that on the right side, it has what's left over that we subtract out as the ending inventory. So when we take the total debit side of cost of goods sold minus the total credit side of cost of goods sold, we get the actual balance of cost of goods sold, and in this example, that's $8,000. And that's how we found out the cost of goods sold, by managing the chart of accounts in the days before the computer. And that cost of goods sold is what we would subtract from the sales income to get the gross profit from buying and selling merchandise. After that, we would subtract our general administrative expenses to get the net taxable